Good morning everyone. I am Shavina, daughter of Chandran, and my matrix number is 307875. Today I will be presenting my research title, which is The Determinant of Credit Risk of the Bank of USA, Flexstar Bank. This study focusing on identifying the factors that influencing the credit risk by looking at both internal factors from the bank itself and external economic factors from 2015 until 2024. Moving into problem statement, this study focuses on the issue of credit risk faced by bank. Credit risk happens when borrowers fail to repay their loans, which can increase non-performing loans and affect the stability of the bank. So poor management of credit risk may create a domino effect affecting the overall financial system. As for the Flexstar Bank, the main concern is its high exposure to mortgage lending and commercial real estate financing. So when loan defaults increase, it can reduce asset quality and create financial difficulties. Flexstar Bank also faces credit risk challenges mainly because of its large lending activities. So when the bank expands its loan, there is a higher possibility that some borrowers may experience repayment problems. This can lead to higher non-performing loans, lower asset quality, and greater pressure on the bank's financial performance. Therefore, effective credit risk management is important to prevent losses and maintain financial stability. Research has three main objectives. First one is to examine how internal factors such as profitability, liquidity, loans, and capital affect credit risk. Second is to analyze how external factors such as GDP, inflation rate, interest rate, exchange rate influence credit risk. Third one is to examine the combination effect of both internal and external factors on Flexstar Bank's credit risk. Then, as for the research question, they are developed based on this objective. As for the literature review, it is based on previous studies which the credit risk is closely related to liquidity risk and bank performance. When credit risk increases, banks may face more difficulty in maintaining liquidity because more loans become unpaid. Previous researchers such as Imbrewik and Roche highlighted that credit risk and liquidity risk are connected because problems in loan repayment can affect the overall stability of the bank. Then, loans are the main source of income for the bank, but they are also the main source of risk. When banks expand lending activities too quickly, the possibilities of borrower default is increased. Proper loan management is important to balance generating income and controlling credit risk. Economic conditions also influence credit risk. During strong economic growth, borrowers usually have better repayment ability, which may reduce credit risk. However, higher inflation can increase borrowing cost and affect customers' ability to repay loan. For the methodology, the study uses secondary data collected from Flexstar Bank's annual report from 2015 until 2024. This study includes both internal and external factors such as profitability, liquidity, loan variables, GDP, inflation, and etc. Then for the dependent variables for the study, it is credit risk. Next, this slide descriptive statistic shows the overall characteristics of the data. The study uses 10 years of observation from 2015 to 2024. The average credit risk value shows that Flexstar Bank experienced moderate risk exposure during this period. Profitability variables like ROA and ROE showed average value of 0.486 and 3.505, indicating that bank performance level. As for the loan and liquidity, it remained relatively stable with mean values of 0.7 and 0.1, suggesting consistent lending and liquidity management. Then, capital adequacy ratio recorded a mean of 14.297, showing the bank maintained capital strength. As for the external factors such as inflation 2.8, GDP growth 2.4, and interest rate around 1.8 showed economic fluctuation during the study period. So overall, the descriptive statistics provide an overview of the average performance, risk level, and variation of the variable used in the study. Next, the correlation analysis explains the relationship between each variable with credit risk. The strongest negative relationships are from loan, ROE and ROA, meaning better loan performance and higher profitability are associated with lower credit risk. Meanwhile, liquidity and loan loss provision shows a strong positive relationship, indicating that the increases in these factors are related to higher credit risk. As for the moderate positive relationship, there are interest rate, yield curve, exchange rate, DTAR, DER, and LN size. In addition, for the weak relationship, there are CAR, GDP growth, inflation rate, unemployment rate, M1, M2, reserve money, leverage, and standard deviation. Overall, profitability and loan related variables have the strongest relationship with credit risk. For the ANOVA test, it is used to determine whether the regression model are statistically significant. As for the ANOVA model 1, the result indicates that the regression equation is statistically significant as the F statistic is 6.948 with a sig value of 0.042, which is less than 0.05. For the model 2, its result indicate that the regression equation is not statistically significant as the F statistic is 1.145 and the sig value is 0.495, which is greater than 0.05. This indicates that all the external factors taken together do not have a statistically significant effect on credit risk. As for the ANOVA 3, the regression equation does not show any statistical significance since the F value is 1.827 while the probability, the P value is 0.59, greater than 0.05. The implication of this that all the internal and the external factor considered in the analysis not shows a statistically significant influence on credit risk. Moving into model summary, it explains how much variation in credit risk can be explained by the independent variable. A higher R-square value means the model has stronger explanatory power. Model 1 summary is the result of the regression analysis on the dependent variable with the internal factors as the predictors. Since the R-square value is 0.897, then it means that 89.7% of the variance in credit risk is explained by the independent variables. As for the model 2, it is the result of the regression analysis on the dependent variable with the external factors as the predictors. With R-square value of 0.696, it implies that 69.6% of the variance in credit risk is explained by these independent variables. As for the model summary 3, it is obtained using the dependent variable along with both internal and external factors as predictors. The R is 0.967, indicates that there exists a very strong correlation between the independent variables. As for the R square, the value of 0.936 indicates that 93.6% of the variation in credit risk can be explained by the above independent variables used in this model. This slide shows the coefficient result for Model 1 and Model 2, which examine the factors affecting credit risk. As for the Model 1, internal factors such as ROA, loan loss provision, leverage, CAR, and reg cap were tested. The result shows that LLP has a positive relationship with credit risk, meaning higher loan loss provision are associated with higher credit risk exposure. Meanwhile, ROA shows a negative relationship, indicating that better profitability may help reduce credit risk. Then, as for the Model 2, external factors such as inflation, exchange rate, GDP growth, yield curve, M2, and standard deviation were analyzed. However, most external factors are not statistically significant, showing that their impact on credit risk is weaker compared to internal factors. So overall, the results suggest that internal banking factors have a great influence on credit risk management. This slide shows the coefficient result for Model 3, which the combination of both internal and external factors to examine their overall impact on credit risk. The result shows that most variables are not statistically significant, meaning they do not have a strong individual effect on credit risk during the study period. However, ROA shows a negative relationship with credit risk, suggesting that higher profitability may help reduce credit risk. Meanwhile, variables such as reg cap, exchange rate, M2, and standard deviation shows a positive relationship, indicating that increasing in these factors may be associated with higher credit risk. In conclusion, the study found that internal factors have a stronger influence on credit risk compared to the external factors. Profitability indicators such as ROA and ROE reduce credit risk because better financial performance improves the bank's ability to manage risk. Loan activities and loan loss provision are also important because they directly relate to borrower repayment ability. Although economic factors such as interest rate and exchange rate, etc., influence credit risk, their impact is relatively weaker compared to internal banking factors. Based on the findings, several recommendations can be suggested. First, Flexstar Bank should strengthen their credit assessment and monitoring to identify risky borrowers earlierly. Second, the bank should improve loan portfolio management to reduce potential defaults. Third would be they need to maintaining strong capital adequacy and liquidity, which is important to observe unexpected losses. Fourth one is they need to enhance the accuracy of loan loss provisioning to prepare for potential credit losses. Lastly, they need to continuously monitor economic changes such as interest rate, inflation, and market condition. That's all from me. Thank you.